my big picture on interest rates and the economy has been extremely influenced by having worked in Japan for over 20 years. Over this time, the Japanese demographics have steadily moved to one of an aging society with low inflation, low growth, and the accompanying low interest rates and credit spreads. Fiscal deficits have been constant due to the low growth and need to spend more on Social Security for the aging population. I see these same demographics playing out in the Eurozone and in the US, but with a slight lag to Japan. The coronavirus has even further pushed a damper down on growth and inflation. And what we've seen is the ECB, the Fed, and the Bank of Japan stepping up QE and interest rates going even lower. In Japan recently, coronavirus hasn't been the breakout has been really low here. And economy has started to go back. Services, people have been going back to work in the offices. People have been traveling domestically, not internationally. And there's a slow pickup in the economy. Once the vaccine gets distributed in the US and Europe, you can see the same bounce in the economy, and it'll bounce strongly back. But then the next phase will be back to this low growth, low inflation, low interest rates because of the demographics and globalization going on here. So what I see is a bounce in 2021 and then these demographic forces taking hold once again. What we've seen in Japan too is yields are not attractive for, say, pension funds or banks, but they have to still maintain, pensions still need to maintain a certain allocation, just say to balance their equity, the risk in their equity portfolio. So when equities tanked in March, there were rebalancing out of fixed income into equities. Banks still need to hold a certain portion of their portfolio for regulatory reasons, and central banks definitely need to diversify their assets. So there's going to be a strong demand, still continued demand for fixed income in Europe and periphery as well, just to pick up a little bit of spread. So these forces are longer term forces. There'll be a shift out of European rates, out of US rates to pick up yield, but there's going to still be a strong demand for the fixed income product.